Welcome and thank you for joining me for Tax Break. This is a podcast about South African tax for South African tax professionals and practitioners. My name is Pieter van der Schwan, and in each episode I share my thoughts with you on a topic or a recent development in South African tax. And I try to do it in a short enough time that you can listen to the episodes whenever you've got a few minutes to spare. Today we're talking about value shifting. So quite a few of the listeners have asked me what exactly is value shifting and what are the tax implications that we need to be concerned about when it comes to value shifting. Now, perhaps as a qualification before I start the episode, it's by no means possible to outline all the different permutations and scenarios that could give rise to value shifting. So I'm going to focus on a few of the concepts. So value shifting typically happens when, in a context where you're looking at transactions that are not taking place at arm's length. So if I'm giving away value, it's very likely that I'm giving it away to a related person rather than just giving away value to an external third party. Now, from a tax perspective, when we're looking at possible non-arm's length transactions and provisions aimed at those, we're looking at connected person rules in a lot of instances. If we look at value shifting from an economic perspective, value shifting happens when value that's held by one person moves to another person. So, and I think to explain the concept, it makes sense to look at what would a value for value transaction look like. So in other words, where there's no real value shifting involved versus one that is not value for value. So let's say I've got a property that's worth R1 million. I sell it to my brother for R1 million in cash. Before the transaction, I've got R1 million, he's got R1 million. We swap the assets, and after the transaction, if you look at my wealth, I still have R1 million, just in a different form. And he's got R1 million, an asset to the value of R1 million. So that's value for value. No value has really moved from one person to another. If we're looking at possibly an extreme example of where something is not value for value, if I've got an asset, so I've got my property of R1 million, and I just transfer the asset, I register it in the name of the family trust. Before the transaction, I've got an asset of R1 million. The trust doesn't have any wealth if it's a newly established trust. After the transaction, I've given up my value, so I don't have any value left, and the trust has got R1 million in value. So in that case, I've shifted some of my wealth to the trust. Now, looking at some of the tax implications, and I think the same qualification as to the scenarios where value shifting can occur would apply here. It's by no means possible to talk about all the tax implications of these types of transactions, but I would like to highlight a few for you. The first one I think you need to keep in mind when it comes to the Income Tax Act is that there are quite a few deemed market value provisions, especially when you're dealing with connected persons. So if we're looking at section 84K, for example, in the context of recoupments, or paragraph 38 of the 8th schedule in the context of capital gains tax, paragraph 38, as an example, says that if a person disposes of an asset to a connected person for consideration that's not arm's length, or on terms that's not arm's length, the person must be deemed to have disposed of the asset for market value. So in other words, you'll pay capital gains tax as if you disposed of the asset for market value, although you didn't get that same value back. Now, I think in the example that I had of I transfer the R1 million property to the trust for let's say R100,000, it's quite clear that that's the type of transaction where this deemed market value rule would then apply to say I'm deemed to have disposed of the property for R1 million. So that's the direct, I transfer the asset to you, I dispose of the asset to my connected person. Not all these transactions happen in that way. So for more indirect types of disposals, the capital gains tax provisions contains, there's a specific provision that deals with value shifting arrangements. Now, this definition looks at and it's concerned with interests in companies, in trusts, and in partnerships. And where there's a change in the interest in that company, trust, or partnership, that happens on terms that are not at arm's length, where the value of one connected person decreases and the value of another connected person increases. And in the case, if that happens, the person whose value of the interest decreases has got a capital gains tax implication. So then it's deemed that there's been a disposal, and the value that's moved would have a CGT effect. An example of where this would happen: let's say I hold 100% of the shares of a company. The family trust comes along, and we assume the company is worth R1 million, whatever is in that company. The family trust comes along, subscribes for shares in this company for R1, and the family trust acquires 99% of the shares of this company. So my remaining interest is 1%. So I've now got a 1% interest in the R1 million that's the value of the trust or the company. The trust came in, paid R1, and gets a 99% interest in the R1 million company that we're looking at. So that's a typical example of where this indirect type of value shifting would happen. Now, there are also some transactions that where value can move that doesn't fall into the direct or the indirect category, or at least the definitions as they contained in the 8th schedule. And one of the permutations where this happens often goes with the rollover relief afforded in sections 42 and 44. So it's not strictly a value shifting arrangement per definition, but there is value moving somewhere. So section 24BA is aimed at that. So that provision deals with value mismatches where an asset is transferred to a company and the company issues shares in exchange for the asset. If there's value moving into the company, there's a capital gains tax effect. If there's value moving out of the company, there's a potential dividends tax effect. And one of the triggers again for this is that the transaction must happen on terms which, if you look at that step in isolation, parties dealing at arm's length would not have agreed to. So let me give you an example of this. So I've got an asset that's worth R1 million. Let's make it the property again. The family trust has got nothing at this point in time. We establish a new company and the family trust holds all of the shares of the new company. Now I transfer my assets, my property into the new company in exchange for 20% of its shares. So the threshold, we meet the requirements of section 42, so I can do that using rollover relief. Now, what section 24BA says, and if we look at it economically before we look at 24BA. So what's really happened here is I've given my asset of R1 million, I've given that up in exchange for shares that represent 20% in the R1 million asset. So I've got a 200,000 Rand asset now. The family trust would sit with an 80% interest in the R1 million asset. So I've really moved 800,000 of value to the family trust using this asset for share transaction. What section 24BA then says is if the transaction happens on terms that you wouldn't find between persons dealing at arm's length, so I wouldn't give my asset of R1 million to someone else in exchange for something that's worth 200 if they're not related. Then there's a value mismatch that you need to look at. And if the value of the asset that goes into the company is more than the value of the shares that the company issues, you've got a CGT effect for the company. Right, so those are some of the income tax implications that you need to consider. I think another obvious one that comes into play is donations tax. So if you just give away the asset, it's a purely gratuitous transaction, then we squarely into the space of donations and what the donation would be. So then there's donations tax on it, whereas And a lot of people don't realize this. If you've got a transaction that happens, it's not a pure donation. You've got a sale, but just for a lesser value than the value of your asset. Section 58 of the Income Tax Act can actually deem that transaction to be a donation if you dispose of property for consideration that the commissioner deems or views as inadequate. You could have a deemed donation that then also attracts donations tax. So donations tax as a category of tax is definitely something to consider. As I've also mentioned, there are other taxes like VAT, like STT, where the legislation also caters for some market value adjustments in the case of certain transactions. Lastly, I think the point in all of this, and hopefully you've already realized it by now, is that in these transactions, valuation is a critical factor. So it becomes critically important to make sure that when you're looking at something that is potentially shifting value, that you are looking at valuations that are properly performed, where there's a sound basis for the valuation that uses a methodology that makes sense, because that could have a big impact from a tax perspective. So valuations in these things are absolutely critical. In summary, when does value shifting happen? It's when you've got an exchange that's not value for value, often between connected persons. What are the types of taxes that you need to consider? The main ones we've covered today, in a lot of cases, there's a CGT impact, a donations impact, but the tax impact, but there could also be others. That's it for today's episode. If you have any questions, comments, ideas for future episodes, please send me an email. My email address is in the show notes. If you like the podcast, please go and subscribe on your favorite podcast platform, like it on YouTube, and of course, tell all your colleagues and friends about it. And then, as always, nothing in this podcast is intended to be tax advice, especially in the context of the topic for today. You need to look at each transaction, each structure in the context of its own facts and circumstances, looking at the values involved, valuations to be used to determine if value shifting is happening or not, and what the tax would be. So the podcast is merely for awareness, to help you to identify where this could possibly be the case. Until next time, goodbye.